The average investor underperforms the S&P 500 by over 3% annually over a 30-year period. Why? Because most people panic sell during market crashes, precisely when savvy investors start buying. I once watched my portfolio drop 40% during the 2008 financial crisis. Instead of selling, I studied Buffett's approach and turned that market collapse into my greatest investing opportunity. Today, I'm revealing 4 psychological and strategic moves that transform market fear into profit. After watching this video, you'll know exactly how to prepare for the next market drop and join the select investors who capitalize on downturns rather than becoming victims of market psychology. The psychology behind Buffett's calm during market chaos. So what exactly happens in Warren Buffett's brain when the market plunges 30% and everyone else is losing their minds? While most investors are panic selling their portfolios and checking stock prices every 5 minutes, Buffett sits back with an almost eerie calm, sometimes even smiling. What's his secret psychological advantage? Let's be real. During market crashes, most of us get hit with a tsunami of emotions. Your heart races, palms get sweaty, and suddenly that retirement account you've been building for years feels like it's evaporating before your eyes. This is your brain's ancient fight or flight response kicking into high gear. Your amygdala hijacks your rational thinking, and boom, you're panic selling at the worst possible moment. But Buffett? His brain operates completely differently during these crisis moments. While everyone else sees disaster, he sees the investing equivalent of a Black Friday sale. He experiences those same biological fear responses as the rest of us. He's just trained himself to override them with a psychological framework that completely flips the script on market downturns. That famous Buffett quote about being fearful when others are greedy and greedy when others are fearful is his actual operating system. The mental framework he uses to make decisions when markets go haywire. And his secret psychological advantage might surprise you. It's his temperament. Buffett himself has said that temperament is more important than IQ when it comes to investing. The Oracle of Omaha believes that managing your emotions is more valuable than being a mathematical genius. He spent decades training himself to resist those primal stress responses that cloud judgment when stocks are tanking. While other investors are driven by panic, Buffett maintains what psychologists call emotional equilibrium. The ability to stay balanced when everything around you is chaotic. One of his most powerful mental techniques? Buffett fundamentally reframes what a stock actually is. While most of us see stocks as ticker symbols, fluctuating prices, and green or red colors on a screen, Buffett sees partial ownership in actual businesses with real value. This completely changes his emotional reaction to price drops. When you see Apple down 25%, your brain registers it as a loss. When Buffett sees the same thing, he's thinking, Apple, the company that makes products used by billions, is now available at a 25% discount. That reframing creates a totally different emotional response. It's exactly like walking into your favorite store and seeing everything marked down 30 to 50%. Most people feel excitement, not panic, when they see sales. That's precisely what happens in Buffett's brain during market crashes. He actually gets a dopamine hit, the brain's reward chemical, when he sees quality businesses available at discount prices. There's another key element to Buffett's psychological advantage: expectation management. Most investors are emotionally devastated by market crashes because they're surprised by them. Buffett, however, expects and prepares for them. He knows market history shows that significant downturns happen regularly. By accepting this as normal rather than exceptional, he removes the shock factor that triggers panic in other investors. Picture going on a boat ride. If you're surprised by a huge wave, you'll probably freak out. But if you're expecting waves and have prepared for them, you'll stay much calmer when they hit. That's what Buffett does with market volatility. He's not surprised by 30% drops because he knows they'll happen eventually. This expectation management creates a psychological buffer that protects him from emotional decision-making. Buffett also employs what psychologists call cognitive reappraisal, the ability to reinterpret an emotional situation in a way that changes your response to it. When markets crash, most investors think, "I'm losing money. This is terrible." Buffett reappraises the same situation as, "Businesses I understand are now on sale. This is an opportunity." Same external circumstances, completely different internal response. This explains why Buffett can maintain his legendary patience during turbulent markets. while others are. Desperate to take action to stop the pain of losses, Buffett has trained himself to separate the emotional experience from the decision-making process. He follows a disciplined, rational approach regardless of what the market is doing. Something that sounds simple, but is incredibly difficult for most humans to actually do. Buffett limits his exposure to market noise that might trigger emotional responses. He famously avoids watching the stock market ticker throughout the day and doesn't have a computer on his desk. By limiting the inputs that could trigger fear responses, he protects his rational decision-making ability. Studies have shown that investors who check their portfolios daily during crashes experience significantly more stress than those who check weekly or monthly, even though the actual financial outcome is identical. Buffett instinctively understands this and protects his mental state accordingly. Another key aspect of Buffett's psychological advantage is his long-term perspective. While most investors worry about next week or next month, Buffett thinks in decades. This time horizon shift fundamentally changes how your brain processes market volatility. If you're focused on a 20-year horizon, a one-year market crash becomes a tiny blip rather than a catastrophe. Perhaps most importantly, Buffett has built a psychological feedback loop from his past experiences. Each time he successfully navigated a market downturn and come out ahead by buying quality companies at discount prices, it reinforces his confidence in the approach. This creates a virtuous cycle where each crisis he weathers makes him even calmer during the next one. He has decades of personal experience proving his approach works. Buffett's rule number 1, never lose money, and how he actually applies it. Those decades of experience have crystallized into Buffett's most famous investing principle. But there's a massive disconnect between how most investors interpret never lose money and how the Oracle of Omaha actually applies it. When stocks are crashing all around, and even Berkshire's portfolio is down billions, what does this rule really mean to the world's greatest investor? If you've ever heard someone quote Warren Buffett's famous rule number 1, never lose money, followed by rule number 2, never forget rule number 1, you might wonder how that's even possible. During the 2008 financial crisis, Berkshire Hathaway's stock plummeted over 30%, wiping out billions in market value. During the COVID crash of 2020, Buffett's portfolio took another massive hit. So is the world's greatest investor breaking his own cardinal rule every time the market takes a nosedive? Not at all, because for Buffett, losing money has nothing to do with temporary price declines. It's about the permanent loss of capital that happens when a business's fundamental earning power gets damaged or destroyed. This distinction transforms how he views market volatility. Take Buffett's investment in the Washington Post during a severe market decline. While the stock price had dropped dramatically, Buffett calculated that the intrinsic value remained largely unchanged. The company still owned valuable assets, maintained a strong competitive position, and generated reliable cash flow. By focusing on these fundamentals rather than panicked market sentiment, Buffett secured an investment that multiplied many times over in the decades that followed. Think about it like buying a house for $300,000 that later gets appraised for $250,000 during a recession. Have you actually lost $50,000? Only if you're forced to sell during the downturn. If the house remains structurally sound, in a good location, and you plan to live there for years, that temporary price decline means nothing to your long-term outcome. Buffett applies this same logic to businesses. He focuses relentlessly on intrinsic value, the actual worth of a business based on its ability to generate cash, rather than whatever price the market is currently willing to pay. This creates a psychological force field against panic during market crashes. When you ask, does a 30% drop in share price change how many Cokes people will drink next year? And the answer is no. Then you understand that the company's intrinsic value remains intact regardless of market sentiment. This is why Buffett can remain unfazed as billions in paper value temporarily vanish during market panics. What's fascinating is how this principle translates into practical action. Buffett prepares for market crashes by keeping substantial cash reserves on hand. In his 2010 letter to shareholders, he formalized this approach by committing to hold at least $10 billion in cash at all times. But typically, he keeps far more, closer to $20 billion and sometimes much higher. Most financial advisors would consider this excessive, especially during bull markets when that money could be invested elsewhere. For Buffett, however, cash is ammunition. When markets panic in quality, Businesses suddenly go on sale. Having cash ready allows him to act decisively, while others are frozen or forced to sell. It's like walking into a store during a 50% off sale with a wallet full of cash, while everyone else is broke or running for the exits. This strategy paid off spectacularly during the 2008 financial crisis. While most investors watched their portfolios collapse, Buffett deployed billions into companies like Goldman Sachs and General Electric, negotiating preferred stock deals with lucrative terms unavailable to regular investors. How does Buffett decide which businesses are worth buying during a crash? He evaluates them based on their ability to both survive the current crisis and thrive afterward. He's not trying to catch the market bottom. He's identifying fundamentally sound businesses unfairly punished by market panic. Buffett looks for companies with robust balance sheets, sustainable competitive advantages that will remain intact after the crisis, and consistent cash flow generation that can weather economic storms. These criteria automatically eliminate most bargains that catch the average investor's eye during market crashes. This approach reveals something profound about Buffett's never lose money philosophy. It distinguishes between price risk, temporary market fluctuations, and value risk, permanent impairment of a business's earning power. The former represents opportunity. The latter is what Buffett truly seeks to avoid. When markets crash and everyone panics, Buffett asks, is this business still going to be generating cash 5, 10, 20 years from now? Has anything fundamentally changed about its competitive position or long-term prospects? Or is this just a temporary price decline caused by market fear? For most quality businesses, market crashes don't change their long-term trajectory. They just offer a discount on the price of admission. That's why Buffett gets excited during these periods while others panic. He's not breaking his never lose money rule. He's applying it exactly as intended, by protecting against permanent loss while capitalizing on temporary price declines. This perspective transforms how you might approach the next market downturn. Instead of seeing your portfolio drop and thinking, I'm losing so much money, you can analyze what's happening to the underlying businesses you own. If they're still selling products, generating cash, and maintaining their competitive positions, then what you're experiencing isn't a loss in Buffett's definition. It's a temporary price decline that will likely reverse when sanity returns to the market. Buffett's $10+ billion crisis playbook, the 2008 financial crisis case study. The 2008 financial crisis wasn't a disaster for Warren Buffett. It was a once-in-a-lifetime shopping spree. When the S&P 500 was plummeting nearly 50%, Buffett deployed billions into specific companies that would later generate astronomical returns. What did he see that almost everyone else missed? Picture this, September 2008. Lehman Brothers had just collapsed. Financial markets were in complete freefall. CNBC was running markets in turmoil specials every night. Trading floors echoed with panicked shouts. Investors stared at screens of bleeding red numbers, frantically calling brokers. The average investor was either frozen in fear or hitting the sell button. But in Omaha, Warren Buffett sat calmly at his desk, making phone calls, not to sell, but to buy. What makes this period so fascinating is the surgical precision with which Buffett deployed his capital. His $5 billion investment in Goldman Sachs demonstrated this strategic approach. Buffett negotiated preferred shares paying a 10% dividend yield, plus warrants to buy additional shares at a fixed price, terms unavailable to ordinary investors. Buffett continued his methodical approach by investing $3 billion in General Electric under remarkably similar terms. Again securing preferred shares with a guaranteed 10% dividend, he effectively created a custom-designed investment vehicle providing both downside protection and substantial upside potential. These weren't random choices. Goldman Sachs and GE represented critical pieces of American financial and industrial infrastructure. Despite the crisis swirling around them, Buffett recognized their fundamental importance to the economy wouldn't disappear overnight. More importantly, he understood that government intervention would likely prevent these too-big-to-fail institutions from actually failing. The structure of these deals revealed Buffett's crisis strategy. By negotiating preferred shares with hefty dividends, he created a safety net providing substantial income even if the market continued downward. Meanwhile, the warrants gave him unlimited upside potential when markets eventually recovered. A classic heads I win, tails I don't lose much position. But Buffett's most audacious move came in 2009. As television pundits, Still debated whether the economy would survive, Buffett made his largest investment ever, acquiring Burlington Northern Santa Fe Railway, BNSF, for approximately $26 billion, the biggest purchase in Berkshire Hathaway's history at that time. This acquisition revealed another dimension of Buffett's crisis investing strategy. While others obsessed over quarterly economic projections, Buffett looked decades ahead. Railroads represent the physical backbone of American commerce, moving goods across the continent with unmatched efficiency. By purchasing BNSF, he made a generational bet on the enduring strength of the American economy. The BNSF acquisition showcased Buffett's ability to see beyond the economic chaos. While most investors wondered if the financial system would survive the month, Buffett planned for the next 50 years. The railroad purchase demonstrated his core philosophy. Identify essential businesses with durable competitive advantages, then buy them when temporary fear drives their prices down. What ties all these crisis investments together? Each one followed Buffett's systematic criteria. First, he targeted businesses essential to the functioning of the economy. Second, each company possessed strong competitive positions that wouldn't evaporate because of temporary market conditions. Third, all were experiencing what Buffett viewed as temporary undervaluation due to market panic, rather than fundamental business deterioration. The results speak volumes. His Goldman Sachs investment eventually generated over $3.7 billion in profit, a staggering 62% return during a period when many investors still nursed deep losses. Combined with his other crisis-era investments, Buffett's total gains exceeded $10 billion. This was the culmination of patience, preparation, and the courage to act when others remained paralyzed by fear. Buffett's approach differed fundamentally from typical buying the dip strategies. He targeted specific businesses where he could extract favorable terms that ordinary investors couldn't access, rather than simply purchasing broad market index funds at lower prices. Equally important is what Buffett avoided during this period. He steered clear of banks with opaque balance sheets, companies with excessive debt loads, and businesses facing structural challenges. This selectivity demonstrates that Buffett applied rigorous analysis, even as prices plummeted across the board. A crucial element of Buffett's crisis playbook was preparation. Berkshire had built substantial cash reserves in the years leading up to 2008, positioning him to act aggressively when opportunities arose. Unlike fully invested peers, Buffett had financial ammunition ready when prices collapsed. This preparation reflected Buffett's perpetual readiness for inevitable downturns. He didn't need to know exactly when the crash would occur, just be ready when it did. This patient approach, keeping powder dry and waiting for obvious opportunities, contrasts sharply with the constant trading most investors engage in. Buffett's comfort with uncertainty also distinguished him. He invested during the market's darkest days, not waiting for clear signals that the worst was over. This willingness to act amid uncertainty separates Buffett from investors who wait for confirmation that markets have bottomed, often missing the best opportunities. Perhaps most impressive was Buffett's long-term perspective, while others focused on short-term concerns. His BNSF acquisition secured vital American infrastructure that would generate cash flows for decades. This time horizon advantage, thinking in decades while others think in days, creates opportunities invisible to shorter-term investors. What can regular investors learn from Buffett's crisis playbook? While we can't negotiate preferred share deals with Goldman Sachs, we can adopt the underlying principles. Maintain cash reserves for opportunities, focus on essential businesses with durable advantages, and summon the courage to buy when headlines are most frightening. The cash reserve strategy, your financial ammunition. That courage to buy during market crashes is only possible if you've got one thing Buffett never runs short on: cold, hard cash. But here's the twist. While financial advisors tell you cash is trash during inflation, Buffett has stockpiled between $20 to $150 billion over the years. What does the Oracle of Omaha understand about cash that almost everyone else misses? For Buffett, cash serves as financial ammunition, a term that completely reframes how we should think about liquid assets. This offensive firepower waits to be deployed at the perfect moment. When you've got this reserve ready, market crashes transform from scary events into exciting opportunities. Think about what happened in 2008. While most investors were fully invested before the crash with nothing left to buy the dip, Berkshire Hathaway was sitting pretty with a $44 billion war chest. When? Everyone else was frozen with fear or forced to sell at the worst possible time. Buffett was shopping for bargains like it was Black Friday. This strategy resembles the savvy shopper who sets aside money specifically for major sales events. While others max out their credit cards on regular-priced items, this shopper can swoop in during the annual clearance and purchase premium goods at fraction of their value, all because they had the foresight to keep powder dry for the right moment. What's truly fascinating is how Buffett formalized this strategy in his 2010 shareholder letter after the dust settled from the financial crisis. He publicly committed to keeping at least $10 billion in cash reserves at all times. Although in practice, he typically maintains much more than that minimum threshold. This was deliberate preparation for the inevitable market panics that others pretend won't happen. Critics argue that holding substantial cash is foolish because it drags down your returns during bull markets. Their fancy charts show how being fully invested outperforms having cash on the sidelines. But what these critics miss is crucial. Emotional resilience during crashes is worth more than a few percentage points of theoretical returns. Picture two investors during the 2008 crash. The first is fully invested, watching their portfolio drop 40% with no ability to buy anything. They're experiencing pure panic. The second has 20% in cash and is excitedly picking up bargains while everyone else is selling. Which investor do you think sleeps better at night? Which one is more likely to make rational decisions rather than emotional ones? Buffett's cash position has fluctuated dramatically over time, showing just how responsive and opportunistic his approach really is. During bull markets, when valuations get stretched, his cash position grows larger. After major downturns, when he's deployed capital into bargains, it shrinks. This is preparation meeting opportunity. In recent years, Berkshire has held record cash stockpiles, showing that Buffett lives this strategy. Even when critics claim he's missing out on gains, he sticks to his guns. His philosophy focuses on being ready when crashes inevitably occur rather than predicting their timing. So what does this mean for regular investors like us? First, we need to separate two distinct cash buckets in our financial lives. Your emergency fund is for life emergencies, job loss, medical bills, car repairs. That money should never be invested in the market. But beyond that, having investment cash, money specifically earmarked for buying opportunities when markets tank, provides tremendous advantage. For regular folks, this might translate to keeping about 10 to 20% of your investment portfolio in cash or highly liquid short-term bonds. This isn't your emergency fund, it's your opportunity fund. It's the money that will give you both financial and psychological advantages when the next crash happens. The psychological benefit cannot be overstated. When you have cash ready to deploy, you actually look forward to market drops instead of dreading them. Your entire emotional relationship with investing changes. You stop seeing red days as disasters and start seeing them as sales. This mindset shift is perhaps the most valuable aspect of Buffett's cash strategy. I've experienced this myself. During past corrections, having even a small cash position completely changed how I felt about the market dropping. Instead of pure anxiety, I felt a mix of concern and excitement. I was spotting new opportunities to deploy capital at better prices. You might wonder, but what about inflation eating away at my cash? It's a fair question, especially in today's environment. This is why Buffett isn't keeping his billions in a checking account. He typically holds treasury bills and other short-term, highly liquid investments that provide some yield while maintaining immediate availability. For regular investors, options like money market funds, short-term bond ETFs, or high-yield savings accounts can serve the same purpose. The key is balancing immediate accessibility with some protection against inflation. Some might point out that we can't all be Warren Buffett. We don't have billions or the ability to negotiate preferred share deals with Goldman Sachs. But the principle of maintaining dry powder works at any scale, whether you've got $10,000 or $10 billion. This strategy might be even more important for average investors. Unlike Buffett, we don't have decades of experience and ironclad emotional control. Having that cash cushion gives us the confidence to act when everyone around us is panicking. Buffett thinks about this in terms of temperament rather than complicated strategy. He's often said that investing success is more about character than brainpower. Having cash reserves during downturns helps bridge the gap between what we intellectually know we should do, buy low, and what our emotions make us want to do, run for the hills. This approach requires discipline, the discipline to hold cash when markets are rising. It means accepting that you might underperform during strong bull markets. But remember, investing isn't about maximizing returns in any single year. It's about maximizing returns over your life. Buffett's value investing checklist during market crashes. While having mountains of cash is useless if you don't know exactly what to buy when everything's on sale, Buffett doesn't simply grab any stock that's dropped 40% during market turmoil. His investment filter during market panics is so stringent that for every 100 seemingly good deals that cross his desk, 99 get immediately rejected. This ruthless selection process might be the real secret to his success. When markets crash, most investors scramble to buy anything that looks cheap. Stock XYZ is down 70% from its high. Must be a bargain. This surface-level analysis leads countless investors into value traps, companies that look inexpensive but are actually cheap for very good reasons. Buffett, however, applies a disciplined framework that filters out almost everything the average investor might consider a deal. Buffett's crash investment checklist consists of 5 essential criteria. 1. Economic moats, sustainable competitive advantages that protect a company's profits even in downturns. These vary by business. Coca-Cola leverages global brand recognition that maintains customer loyalty regardless of economic conditions, while American Express benefits from network effects that increase value as more people use their payment system. During market crashes, companies with strong moats maintain pricing power and market share while competitors falter. These businesses often emerge stronger as weaker rivals collapse. 2. Fortress-like balance sheets. Buffett avoids companies carrying heavy debt loads, regardless of other attractive qualities. During severe downturns when credit markets freeze, heavily leveraged companies face existential threats while trying to refinance debt. As Buffett remarked, when you combine ignorance and leverage, you get some pretty interesting results. Those interesting results typically mean financial disaster. Companies with minimal liabilities not only survive economic storms, but often acquire struggling competitors at bargain prices. 3. Consistent earnings history, particularly through previous recessions. This track record proves the business model functions across all economic conditions. Think of this criterion like checking a car's maintenance history before buying it. If it's performed reliably through previous rough terrain, it's more likely to handle future challenges. This explains Buffett's preference for consumer staples, insurance, and utilities, sectors with relatively stable demand regardless of economic conditions. 4. Simple, understandable business models. Buffett famously avoids technology companies or businesses with complex structures because complexity creates uncertainty and risk. Never invest in a business you cannot understand, Buffett advises. When a company's operations can be explained in a single sentence, it's easier to identify threats and accurately value future earnings. This clarity becomes invaluable during market crashes, allowing decisive action while others hesitate. 5. Substantial margin of safety. Perhaps most important, Buffett insists on a significant gap between market price and intrinsic value. While most investors celebrate finding stocks trading 10% below estimated value, Buffett often waits for discounts of 25% to 50%. This margin serves as a safety buffer, like driving well below the speed limit during a storm. If Buffett overestimates a company's worth by 15% but buys at a 30% discount, he's still getting a bargain. Additionally, these steep discounts build in future returns as prices eventually reflect true value. During market crashes, this principle becomes especially powerful. When fear dominates, even excellent businesses with strong fundamentals trade at dramatic discounts. These moments of maximum pessimism create the exact buying opportunities Buffett patiently awaits, sometimes for years. The combination of these 5 criteria creates an incredibly selective filter, explaining why Buffett might examine hundreds of businesses during a crash, but ultimately invest in only 2 or 3. The companies passing all tests represent the rare intersection of quality and value, forming the foundation of his investment philosophy. For everyday investors applying Buffett's framework, preparation before market crashes is key. Creating a watch list of companies meeting the first 4 criteria during normal conditions means you'll be ready when prices drop, and the 5th criterion suddenly materializes. Many people believe Buffett's success comes from mysterious market timing abilities or exclusive information. The reality is simpler but harder to execute. He applies a disciplined framework to identify quality businesses and waits patiently for prices to fall below their worth. Market crashes create opportunities for this strategy to work spectacularly well. This approach works because it's both defensive and offensive simultaneously. The same factors protecting capital. During downturns, economic moats, low debt, earnings stability, and business simplicity position these companies to thrive when conditions improve. This explains how Buffett not only preserves wealth during market crashes, but emerges richer than before. Dollar cost averaging, the Buffett principle for regular investors. While Buffett waits years for the perfect moment to deploy his billions, your monthly paycheck might actually be your greatest investing superpower. That regular income stream gives you access to a mathematical advantage that even Warren Buffett can't fully utilize. I'm talking about dollar cost averaging, the surprisingly simple strategy that automatically turns market drops into wealth-building opportunities without requiring perfect timing or billions in the bank. Most of us don't have massive cash reserves sitting around waiting for the next market crash. We're working jobs, earning regular paychecks, and trying to build wealth month by month. That's exactly where dollar cost averaging thrives. Instead of timing the perfect moment to invest a large sum, you simply commit to investing a fixed amount at regular intervals, weekly, monthly, or quarterly. The genius of this approach automatically implements Buffett's "be greedy when others are fearful" principle without requiring special decisions during market downturns. When stock prices drop, your fixed investment amount naturally buys more shares, like a shopper who automatically gets more groceries when prices are on sale. When prices rise, you buy fewer shares. This systematic approach removes emotion from the equation, precisely what Buffett has mastered through years of experience. Let me show you how powerful this can be with real numbers. Imagine you invest $500 every month into an index fund. In month 1, the share price is $50, so you buy 10 shares. Then the market takes a dive, and in month 2, the price drops to $40 per share. Now your same $500 buys 12.5 shares. You're scooping up 25% more ownership for the same money. If the market recovers in month 3 and the price jumps to $60, your $500 gets you 8.33 shares. After 3 months, you've invested $1,500 total and acquired 30.83 shares at an average cost of $48.66 per share. That's less than the current market price of $60. Without trying to time the market, you've positioned yourself for profits simply by staying consistent through the volatility. This mathematical advantage means you naturally buy more shares when prices are low and fewer when they're high. The approach works most effectively when markets are volatile, exactly when emotional investors make their biggest mistakes. Picture this. When the market drops 30%, your fixed investment suddenly buys 43% more shares each month without changing your strategy. You're automatically being greedy while others panic. This is why Buffett himself recommends index fund dollar cost averaging for most individual investors. He's famously said, "The best thing to do is invest in an index fund over a long period of time." He understands that most people don't have his decades of experience or billions in cash, but they do have regular income that can be systematically invested. Studies consistently show this approach outperforms attempts at market timing over the long run. The data is clear. Investors who jump in and out of the market based on predictions typically miss the market's best days, which often occur during volatile periods. An investor who missed just the 10 best days in a 20-year period would have $3 million less in earnings on a $1 million investment compared to someone who stayed fully invested. Dollar cost averaging helps avoid this costly mistake. Now, want to supercharge these results with minimal extra effort? Consider implementing enhanced dollar cost averaging. Like adding a turbocharger to an already reliable engine, this simple twist can dramatically improve performance. During significant market drops, 20% or more, increase your regular contribution by 10 to 25%. This allows you to capitalize even more on discounted prices while maintaining the disciplined approach that makes the strategy so effective. This enhanced approach works across various investment accounts. Your 401k contributions, IRA investments, and brokerage account purchases can all follow this principle. In fact, if you're already making regular contributions to a 401k, you're practicing dollar cost averaging. You're building a retirement nest egg through the power of buying more shares when prices fall. What makes this strategy particularly valuable is its effectiveness for volatile investments. While Buffett focuses on stable businesses with strong fundamentals, regular investors using dollar-cost averaging can apply this approach to more volatile sectors like emerging markets or technology stocks. The greater the price swings, the more this strategy can lower your average cost basis. Remember that dollar-cost averaging isn't a magic bullet. It doesn't guarantee profits in a market that continues declining without recovering. The strategy works on the fundamental assumption that markets eventually rebound, the same assumption underlying Buffett's approach. The difference is you don't need to predict exactly when that rebound will happen. Some critics argue that lump sum investing outperforms dollar cost averaging in rising markets, which is mathematically true. If markets only rose, putting all your money in at once would be optimal. But markets fluctuate, sometimes dramatically. Dollar cost averaging provides both mathematical and psychological advantages during these inevitable periods of volatility. The psychological benefit is substantial. By committing to regular investments regardless of market conditions, you develop the habit of consistent investing. This removes emotional barriers that prevent people from investing during downturns, precisely when the best opportunities often exist. You're less likely to panic sell because your strategy already accounts for market fluctuations. Another advantage is accessibility. Anyone with regular income can implement this strategy, regardless of investment knowledge or experience. You don't need special access to opportunities, billions in capital, or decades of market experience like Buffett. You just need consistency and discipline, qualities within everyone's reach. Buffett's surprising approach to diversification. Dollar-cost averaging makes investing accessible to everyone. But what if I told you that another cornerstone of investing wisdom might be completely backwards? Warren Buffett, the man who's outperformed the market for decades, deliberately ignores the diversification advice most financial advisors consider sacred. Why would one of history's greatest investors concentrate most of his billions in just a handful of companies when experts insist you need dozens? Instead of spreading his money across 30, 40, or 100 different companies, Buffett concentrates 70 to 80% of Berkshire Hathaway's massive portfolio in just 5 to 10 companies. This strategy flies directly in the face of what most financial professionals recommend. While conventional wisdom suggests building a diverse garden of investments, Buffett prefers to nurture a few exceptional trees, giving them space to grow tall rather than managing an entire forest of saplings. Buffett calls diversification protection against ignorance. He genuinely believes that if you truly understand a business, its competitive advantages, its financials, its future prospects, then you don't need to hedge your bets across dozens of companies you know less about. When you walk into a financial advisor's office, you'll probably hear, "Don't put all your eggs in one basket." It's the mantra that's been drilled into investors for generations. Diversify across small caps, large caps, growth stocks, value stocks, international markets, bonds, REITs, and probably some obscure asset class you've never heard of. The theory makes sense on paper. Spread your money around so that when one investment tanks, the others might save you. Buffett looks at that conventional wisdom and basically says, "Thanks, but no thanks." Let's put this in perspective. When most investment managers would be sweating bullets with such a concentrated portfolio, Buffett sleeps like a baby with billions riding on just a handful of companies. His largest position alone, usually Apple these days, might make up 20 to 30% of his entire portfolio. For comparison, most financial advisors would have a heart attack if you told them you wanted to put even 10% of your money in a single stock. Buffett isn't trying to own a little bit of everything. He's trying to own a lot of a few extraordinary businesses. His philosophy is that it's better to have a significant stake in 10 companies you understand deeply than smaller positions in 50 companies you only understand superficially. This approach connects directly to Buffett's concept of a circle of competence. He only invests in businesses he thoroughly understands. If it's outside his circle, like cutting-edge tech companies or biotech firms with complex science, he simply passes, no matter how promising they might seem to others. By staying within his circle of competence, he makes better-informed decisions about the few companies he does invest in. You don't have to be an expert on every company, or even many, Buffett once explained. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. That's why his major holdings read like a who's who of relatively straightforward businesses. Apple, Bank of America, Coca-Cola. Companies with business models he can understand and evaluate with confidence. When he puts a significant portion of Berkshire's portfolio into these companies, it's because he believes he knows exactly what he's getting. But here's where Buffett might surprise you. He doesn't actually recommend his concentrated approach for everyone. In fact, he suggests something completely different for regular investors who don't have his decades of experience or the time to deeply research individual companies. For most people, Buffett recommends broad index funds, essentially the opposite of his own strategy. Why? Because he recognizes that not everyone has the time, knowledge, or temperament to research companies with the same depth he does. If you can't confidently assess the long-term prospects of individual businesses, then broad diversification through index funds makes perfect sense. This creates what investment pros call a barbell strategy, with two very different approaches at opposite ends. Either concentrate heavily in a few businesses you understand extremely well, like Buffett does, or diversify broadly through index funds, like he recommends for most people. What he doesn't recommend is the middle ground that many investors end up in, owning dozens of individual stocks they don't fully understand. Think about this. If Warren Buffett, arguably the greatest investor of all time, admits there are vast swathes of the market he doesn't understand well enough to invest in, what does that say about the average person trying to pick stocks across every sector? This doesn't mean you have to abandon individual stock picking entirely. It means being honest about your circle of competence. Maybe you work in healthcare and deeply understand that industry. Perhaps you've spent years in the tech sector and can evaluate software companies better than most. That specialized knowledge can be valuable, but only if you stick to what you know. The key takeaway isn't that diversification is bad. It's that uninformed diversification doesn't actually protect you. Owning 30 stocks you barely understand isn't necessarily safer than owning 5 stocks you know inside and out. As Buffett puts it, diversification makes little sense if you know what you are doing. For many investors, the perfect solution might be a hybrid approach. Put most of your money in broad index funds for that baseline diversification, then carve out a portion, maybe 10 to 20%, for individual companies that fall within your circle of competence. This gives you the safety net of diversification while still allowing you to leverage your specific knowledge where you might have an edge. What's truly remarkable about Buffett's approach is how it challenges us to be honest about what we know and don't know. In a world where everyone's expected to have an opinion on everything, Buffett's willingness to say, "I don't understand that, so I won't invest in it," is surprisingly refreshing. Market crash warning signs. What makes Buffett raise cash? That index fund advice works great during normal markets, but Buffett's personal fortune explodes during market crashes for a very specific reason. Ever notice how Berkshire's cash pile mysteriously grows to record levels just months before major market meltdowns? The reason isn't market timing. It's his disciplined attention to warning signs most investors are too caught up in bull market euphoria to notice. Here's what's fascinating about Warren Buffett. While he consistently claims he can't predict market crashes, his actions tell a different story. He's extraordinarily observant of patterns that typically precede major downturns. Think of him as a weather forecaster who can't tell you exactly when the storm will hit, but can definitely see the dark clouds forming on the horizon. Buffett watches 5 critical warning signs that function like pressure gauges on an overinflated balloon, each indicating the market might be ready to pop. 1. The Buffett indicator, total market capitalization divided by GDP. When this ratio exceeds 140%, we've entered bubble territory. This happens when stock values dramatically outpace what the actual economy produces, like housing prices in 2007 that made no sense compared to actual incomes. The math eventually corrects itself. 2. Excessive corporate borrowing, particularly when companies take on massive debt to buy back their own stock. During good times, this financial engineering looks brilliant as earnings per share rise. But these debt-laden companies get crushed when the economy slows. It's like watching someone max out credit cards for home renovations right before losing their job. 3. Widespread speculative behavior. Before the 2000 crash, Buffett noted taxi drivers and hairdressers suddenly offering hot stock tips. When everyday conversations at parties shift from sports to how much someone made on random stocks, Buffett builds his cash fortress. This pattern recognition helps him identify when investment mania has infected the general public. 4. Declining corporate profit margins across multiple sectors. This subtle warning sign resembles a slight fever before serious illness. When companies broadly make less money on each dollar of sales while the market keeps rising, it signals a disconnect between business performance and stock prices, the market running on fumes rather than fundamentals. 5. Rising interest rates after prolonged stability. When rates climb after years of easy money, it's like oxygen slowly being removed from a room. Companies that thrived in zero-interest environments find their business models breaking down as debt becomes more expensive and consumer spending decreases. What's brilliant about Buffett's approach is that he doesn't need all 5 warnings to flash red before acting. Even 2 or 3 indicators will cause him to gradually increase cash positions. This is preparation, not panic. While others continue celebrating, Buffett quietly collects ammunition for opportunities that inevitably emerge during market crashes. Before the 2008 financial crisis, Berkshire's cash position grew to $44 billion as Buffett observed excessive debt throughout the financial system, particularly in housing. He wasn't making dramatic predictions. He simply followed his disciplined process of reading warning signs and preparing accordingly. The result: when institutions like Goldman Sachs and General Electric desperately needed capital during the crisis, Buffett had cash available. He thrived during the 2008 crash, negotiating deals regular investors could only dream about. The good news: regular investors can apply this strategic thinking without billions. These warning signs are publicly available information. The Buffett indicator is easily found online. Corporate debt levels appear in quarterly reports. You can observe speculative behavior in daily life. Financial media regularly discusses profit margins and interest rates. The challenge isn't accessing information. It's having discipline to act when everyone around you makes easy money and calls you crazy for being cautious. Building cash positions becomes psychologically difficult when markets consistently hit new highs. Your brain creates justifications for why this time is different. Buffett's superpower isn't analysis. It's remaining rational when others become emotional. He doesn't try to time exact market tops or bottoms. He recognizes when risk is high and reward is low, then positions himself accordingly. This doesn't mean selling everything when warning signs appear. Buffett doesn't either. He gradually shifts from offensive to defensive posture. He increases cash reserves, becomes more selective about purchases, and ensures existing holdings can weather severe downturns. For regular investors, this might mean gradually increasing cash from 10% to 20% as warnings accumulate, becoming more stringent about valuation before buying stocks, or stress testing your portfolio to ensure you can handle 30 to 50% declines. This approach doesn't require perfect timing. You're not predicting exactly when markets will crash. You're recognizing when conditions favor a crash and positioning yourself to capitalize when it happens. The crucial distinction: Buffett isn't a market timer, he's a market preparer. Market timers try predicting exact tops and bottoms, failing almost universally. Market preparers recognize elevated risk, take reasonable precautions, and remain ready for opportunities. By monitoring these 5 warning signs and adjusting your strategy as they accumulate, you can position yourself to profit significantly from building your personal market crash playbook. Recognizing warning signs is only half the battle. It's what you do when the market actually crashes that determines whether you'll emerge wealthier or wounded. Think you'd stay calm and rational while watching your portfolio drop 30%? Without a pre-written playbook guiding your every move, your brain's fear center will likely override your investing logic at the worst possible moment. Let's be honest, most of us plan to buy the dip when markets tank, but when that scary red screen shows your retirement account dropping thousands daily, those plans evaporate. Research shows the average investor significantly underperforms the market because emotions hijack decision-making during critical moments. That's why we need to build your personal market crash playbook now, while markets are calm and your brain isn't flooded with stress hormones. This playbook is the essential tool that separates successful investors from those who repeatedly buy high and sell low. Here's how to create your market crash playbook in 5 straightforward steps. 1. Create your opportunity watch list. A carefully curated list of 10 to 15 high-quality companies that you understand well and would love to own at the right price. These should be businesses whose products you use, whose competitive advantages you grasp, and whose financial statements you've actually examined. This pre-vetted list prevents impulsive decisions when panic spreads, allowing you to focus exclusively on price rather than getting distracted by market noise. 2. Calculate and write down your specific by price for each watchlist company. This should be approximately 25 to 35% below what you honestly believe the company is worth. This margin of safety ensures against valuation mistakes and provides extra upside potential when markets recover. Writing these by prices down today, not when the market is falling, anchors you against emotional drift when chaos hits. 3. Establish your cash reserve strategy. Decide exactly what percentage of your portfolio you'll keep in cash specifically for market crash opportunities. For most individual investors, 10 to 20% makes sense, though you might adjust higher as warning signs accumulate. Having this predetermined cash allocation prevents frantically selling other investments at terrible prices when opportunities appear during a crash. 4. Set up automatic buying triggers that remove emotion from the equation. The simplest approach is traditional dollar-cost averaging, investing a fixed amount regularly regardless of market conditions. A more advanced approach involves setting specific price alerts for watchlist companies. Some brokerage platforms even allow conditional orders that execute automatically when prices hit your targets, completely removing the emotional component. 5. Create a crash communication plan, identifying who you'll talk to and avoid when markets plunge. Include a support system, a level-headed investing friend, a financial advisor who understands your long-term goals, or an investing journal. Equally important, identify who to avoid: the doom-scrolling relative, the panicky coworker, or anxiety-inducing financial news shows. Let me share how this works in practice. During the COVID crash of 2020, John, one of my subscribers, had his watch list ready with 12 thoroughly researched companies. His buy prices were predetermined, 30% below his fair value estimates. He had positioned 15% of his portfolio in cash, ready to deploy. When markets plummeted, John didn't make complex decisions under pressure. While his colleagues frantically discussed economic collapse scenarios, he quietly consulted his playbook and executed his plan. He reconnected with his financial advisor, part of his communication plan, who reinforced his strategy. John methodically added to positions in 3 companies that hit his buy targets, including a technology company he'd used for years and understood intimately. 18 months later, those specific positions had gained over 70%. But the real value went beyond profits. John described feeling strangely calm during the market chaos. Rather than experiencing the paralyzing fear that gripped many investors, he felt empowered by his preparation. The beauty of this system works regardless of your investment knowledge or account size. Whether managing $5,000 or $5 million, a written plan dramatically changes your behavior during market stress. Without it, you're gambling that your emotional state during a crisis will lead to good decisions. Psychological research firmly suggests it won't. Your market crash playbook doesn't need complexity. A single page with your watch list, by prices, cash strategy, automated triggers, and communication plan is sufficient. The key is having it written and easily accessible when markets turn chaotic. This approach solves the paralysis from information overload during market drops. When thousands of stocks suddenly appear on sale, most investors become overwhelmed and miss opportunities entirely. Your watch list transforms an overwhelming universe of choices into a manageable decision framework. Building your playbook now creates another benefit. It gives you something proactive to do while waiting for the next market downturn. Rather than anxiously wondering when markets might crash, you can focus energy on preparing your plan, researching quality companies, and setting up your systems. This transforms your mindset from fearful anticipation to strategic preparation. Emotional resilience, overcoming the fear that sabotages most investors. Strategic preparation sets the stage, but there's a reason most investors still fail when markets crash, and it has nothing to do with their intelligence or plan quality. Did you know your brain processes market crashes in the same region that handles life-threatening danger? This biological reality explains why even investors with perfect crash playbooks often abandon them when real panic hits. The difference between Warren Buffett and the average investor isn't just strategy. It's emotional resilience that can be systematically developed. Studies consistently show that the average investor underperforms market indexes by 2 to 4% annually. This performance gap occurs because emotions hijack decision-making during critical moments. When your portfolio suddenly drops 30%, your brain's ancient fear circuits activate as they would if you encountered a predator, triggering fight-or-flight responses that sabotage investing results. Emotional resilience isn't innate. It's a set of skills and habits developed through specific practices. Here are 5 powerful emotional resilience techniques used by professional investors to override biological fear responses during market chaos. 1. Historical perspective. Professional investors study market history, both intellectually and emotionally, training themselves to see the temporary nature of severe downturns. Financial research confirms, after significant declines, U.S. stocks have tended to break even quickly, and market declines are inevitable and completely normal. Exercise. Create a recovery timeline of the last 5 major market crashes. Note recovery periods and outcomes for those who sold versus stayed invested. Review this document monthly, especially during volatility. Like a sailor studying tide patterns, this historical knowledge becomes your anchor during storms. 2. Conscious reframing. Change the language and mental images you use to describe market events. Instead of disaster language like collapse or bloodbath, train yourself to use opportunity language. Sale, discount, buying opportunity. Exercise. When a researched stock drops 30%, practice saying, "Great, I can now buy shares at a 30% discount." This aligns with Buffett's strategy of being greedy when others are fearful, creating a different emotional experience of the same event. Think of yourself as a strategic shopper spotting bargains, rather than a victim of market forces. 3. Information diet control. Excessive financial news during crashes creates anxiety feedback loops that guarantee poor decisions. As investment experts note, during periods of market volatility, investors listen to the news and get too caught up in the action, leading to emotional decisions and costly mistakes. Exercise. Create a market crash media plan, specifying exactly what sources you'll check and how often. Consider checking your portfolio weekly instead of daily during downturns. Like a pilot in turbulence focusing only on essential instruments, this information discipline prevents the anxiety spiral leading to panic selling. 4. Decision journaling. Document investment decisions and reasoning to create accountability and learning opportunities. Financial experts observe, when done correctly, decision journaling provides a solid framework for staying true to long-term beliefs without being swayed by short-term market volatility. Exercise. Record each buying or selling decision with reasoning, expected outcomes, and time horizon. During crashes, review your original thesis before making changes. Like a captain's log during a storm, this creates psychological distance between emotions and decision-making. Simply writing, "I want to sell XYZ stock because I'm afraid it will keep falling," often reveals the emotional rather than logical nature of the impulse. 5. Stress testing. Mentally rehearse how you'll feel and act during various crash scenarios before they happen. Investment professionals emphasize that forethought is essential. Exercise. Regularly imagine scenarios like, "What would I do if my portfolio dropped 30% next month?" Walk through emotional reactions and planned responses. Like a firefighter running drills before an actual fire, this mental preparation activates the neural pathways used during stress, strengthening them for when real market challenges arrive. Maintaining emotional control during severe market downturns remains challenging. Preparation and practice before crisis hits are essential. Pick one technique each month to develop. Start with historical perspective, then create your reframing practice, and so on. By cycling through all 5 techniques, you'll build a psychological toolkit serving you through any market environment. Remember Buffett's wisdom. The most important quality for an investor is temperament, not intellect. Your investment returns ultimately depend more on controlling emotions during critical moments than on picking perfect stocks or timing markets precisely. Emotional resilience compounds over time, just like investment returns. Each market correction you successfully navigate strengthens your ability to handle the next one. After experiencing several market cycles with these techniques, you'll find yourself naturally calm during periods when others panic. Not because you're emotionally numb, but because you've developed the psychological infrastructure to process market events rationally. So here's the truth that Warren Buffett understands better than anyone. Market crashes aren't random disasters. They're inevitable opportunities that reward the prepared. His famous advice to be fearful when others are greedy and be greedy only when others are fearful is the foundation of generational wealth. The most powerful action you can take today is creating your market crash playbook before emotions cloud your judgment. By planning now for how you'll respond when markets tumble, you position yourself to act with confidence while others freeze in fear. Start your playbook today. Your future financial security depends on the